You're listening to the Different by Definition show, sponsored by us, the Definition Private Wealth and Consulting team of Raymond James. Join us to hear from community leaders, business owners, and award-winning financial advisors on defining moments that have shaped the community we live in. Hello and welcome to another episode of the Different by Definition show. I'm your host today, Nick, and I'm joined by Scott, and this is part one of a two-parter. It's actually kind of a New Year's resolution focused episode we have today. So it's New Year's resolutions, finance edition. So this first one, we're going to talk about just a few New Year's resolutions that are important to keep in mind. And then we've also, over the last few months, as we've kind of made this transition into the digital world, like doing podcasts and YouTube and Spotify and all these things, we've actually been getting quite a few requests to make some more educational content, either for kids of our clients or for investors who, 20s and 30s who are just starting out. Mm-hmm. So part two of this is actually going to be New Year's resolutions for, again, kind of that younger generation, more of an educational focus. But this first one is going to be good New Year's resolutions to keep in mind that we have come up with. So any opening commentary, Scott?
Yeah, actually, as we were, just like we advise with clients, right, we do a year-end review of the practice. And wow, 2024 was a crazy year. We had Nick as the addition to the practice. So there's 5 of us now. We crossed 500 million for the first time.
It's a huge milestone
of client assets that we're managing. We rebranded, new team name. Mm-hmm. So it was an incredible year. Just really looking forward to hopping into 2025 on a great note. And I think some of the stuff we're going to talk about today will allow all of you to hop on to a great note. And hopefully a year from now, we'll be talking all the great things that happened.
Yeah, no shortage of change and good things that happened, not just for our team, but for our clients too in 2024, which is cool.
Absolutely.
Excited for the same to be the case in this coming year. So let's jump in. One of the first resolutions or things to keep in mind as we're going into the new year that we have here, it's reviewing and adjusting your financial goals regularly. And something that Scott and I talked about before we hit the record button here was that it's great to just simply have financial goals. And if you have goals that you're tracking regularly, kudos to you. You're ahead of the majority of the population, just because you're not aimlessly saving just because that's what your parents did or that's what you think you should do. If you actually have goals with metrics that you're tracking, that's awesome. But it is important just to check in on those goals and give yourself kind of your own internal review. How are we tracking? Oh man, we had a big unexpected expense this year, so we didn't meet this goal, but here's how we're going to fix that next year or get better. So checking in on those goals regularly is definitely important.
One of the big things too that we see overlooked is oftentimes it's just up here only. Goals can change quite rapidly when it's just in your head. So if you're married or have a significant other, somebody else in your life, make sure that you're sitting down together to go over what both your goals are, what your united goals are, and actually write it down. If you're a single individual, write it down. Put it on the wall, a place that you're going to see it frequently. Just kind of that accountability.
Yeah. And again, regularly checking those goals is important too. When we were talking about this note, it reminded me of it was a keynote speaker that I heard at a sales meeting for Stryker years ago, and I forget the name of the book, I forget the name of the speech, but it was more about talking about how you can set a goal, people congratulate you, like, oh, Scott, you're going to run a marathon, congratulations. Like, what are you congratulating me for? I haven't even started
yet.
Yeah, I know. Nor have I trained.
Yeah, right.
But the middle between that long time of training when no one's looking or watching or remembering, and you're just trudging along, training for your marathon, or trudging along, saving for retirement or whatever it is, you get no recognition or congratulations until race day as well. But it's that time in the middle where accountability of yourself is really important, especially when no one's looking. So having those metrics or check-ins along the way to say, how am I doing to these goals? Just like training for a marathon, super important.
And like we've talked about in a previous podcast, was oftentimes it's the journey that's the most exciting. So it's those moments where nobody's seeing, you're actually training, in this case, saving, marching towards the goal. That's most exhilarating. One of the other things I'd bring up, we do this here within the team as well, is have 2 sets of goals. One being more of your goal that you know that you have a really high probability of hitting. And then don't be afraid to have aspirational goals, kind of that, dream board, as I've heard my wife say a couple of times, something that you know that you're really striving for, maybe out of the park kind of goal, but that's a great way to really kind of nudge yourself forward.
Yeah. You reminded me of, yet again, another speaker that I heard, and we'll move through the other points quicker than this one, but this one's actually kind of an interesting story. So author of a book, keynote speaker at yet another event that I was at in my previous career.
Nick likes events. Just kidding.
Huge event guy. But he wrote a book. It was something about chasing failure, I think was the name of it. But it was more like real life examples of how if you shoot for the moon and you fail, you still land among the stars.
Yeah.
And he was not a super athletic guy, just an author, but he talked about how he had this dream of playing for the Phoenix Suns, which is an NBA team.
Yeah.
And he reached out to the owner and the PR manager and said, hey, I would love to write an article or a story about training for you guys. And could I have the opportunity to come train with you? Or could I try out for the team or something to that effect? And he said, I sent this note to them assuming that they would never even respond. But fast forward a month or two after he sent the note, and he was actually invited to come do a week's worth of practice with the Phoenix Suns. And he said, I never expected this to materialize into anything, but my dreams of being an NBA player, I pursued them. I didn't become an NBA player, but he's like, this is just a surreal moment of standing on this court surrounded by literal giants, and he's getting exercise and work out with them. So shot for the moon, didn't land on the moon, but landed amongst the stars. Kind of a cool story, right? That's important, a baseline goal and a stretch goal.
Very much so.
That's a good point. Okay, we'll move quicker through these other ones. The second resolution thing to keep in mind is reviewing your investment strategy or your allocation. And you had a good point on this earlier. Depending, like the kind of year we had, it's perfect time to do that.
Yeah, so and this gets overlooked because it's just easy to kind of set it and forget it on your investment plan if you're not working with an advisor. After a year, or really the 2 years that we've had with very high returns in the stock market, if you were just to have a portfolio, let's just say it's a 60% stocks, 40% bonds and cash portfolio 2 years ago, that same account today is not 60-40 anymore. It's probably more like 75-25, just because the stock market exposure increased so dramatically. And so if left unattended or not looked at, you can wake up in a couple of years and have a much riskier investment portfolio than you really intend to have. So it's very important to kind of evaluate that on an annual basis. Gives you a great time too to review your investments, make sure that you don't have any underperformance or areas that need to be swapped out. Is there inefficiencies that's in the account that can be addressed? It's just a great time to do that.
Yeah, good point. So in other words, what you're saying is because of the great market performance in 2024, people could be inadvertently overexposed to riskier investments just because of the growth, right?
And oftentimes, it's okay to take some gains off the table. Mm-hmm. A lot of times when market is just running, we don't want to let go of investments because it's that kind of rear view mirror. Oh, this made X amount of money. I don't want to sell it now. That's usually the time period of which you want to reduce it at least.
Yeah.
And that's one of the things that we bring to the table is we kind of remove that emotional element and we bring more of an academic, let's look at it in logical sense, to make sure that your investments align with that goal that we talked about here, last data point.
Yeah. It's funny how goals can magically change during times of market overperformance.
Yes.
Hey, I reached my goal. Maybe just a little bit longer?
Right.
A little bit longer just to see? Yeah, put it all on black. So again, importance of having goals and sticking to them. And you're right, we can be that emotional barrier between people and their money and use history as a guide and kind of the academic side of making decisions.
In what we find, we're all humans. When things are going very well, we tend to all be very comfortable with risk. Oh, no problem. Let's more risk for return. It's not until things get a little bit bumpy where it's just like, oh, wait a minute. I'm not really that aggressive. So it's important to kind of be honest with yourself and evaluate truly what kind of investor you are. And also, if your goal doesn't require a high rate of return, why stretch? If you know you're going to get to the destination, it's that if we're in a car going to California, if the GPS says I'm going to get there in the time that I want to get there, there's no reason for me to go 150 miles an hour down the highway. I'm going to get there when I want to get there. Yeah.
Yeah. So great time of year to readdress your allocation because if there's any volatility in the market next year, it could impact you more than you may think, again, just because of portions of your portfolio might have grown to a larger percentage because of the overperformance in the last 18 months or so.
Absolutely.
Cool. Okay, so the next thing is reviewing retirement plan contributions, whether it's a workplace plan or even traditional and Roth IRAs that maybe you have on the side. So talk to me about the importance of doing this.
Yeah, so there's two parts to this. One is it's not a, what's that inventor, the Ron Co, the set it and forget it.
Oh yeah,
Right?
Not the before the air fryer.
Yes,
It's like
exactly.
some pressure cookers.
Exactly, it's like a rotisserie thing.
Exactly. Yeah.
Your retirement contributions to your employer plans need to be addressed at least once a year. We want to continue to try to increase that contribution. A lot of the plans will allow you just to make an election where every year it bumps up by a predetermined percentage.
Mm-hmm.
So we want to evaluate that. And then the second part is almost every plan these days offers pre-tax, or also known as traditional 401k, and Roth. And a lot of clients are really not quite as familiar about what the Roth part is. It's in your election when you're making the contribution, but if you don't know what it is, it's why check that box. It's a tool that's overlooked. Definitely needs to take into account where you're at, time to retirement, tax bracket, all of those variables, but it essentially would allow you to put money in after tax, so you don't get the tax deduction, but then it grows tax-free.
Mm-hmm.
Huge benefit in retirement, and depending on your own individual circumstances, a lot of times that actually may be the best place to put all of your contributions.
Mm-hmm.
So it's definitely something that needs to be addressed.
Yeah, the Roth side of things is super powerful, more so for younger investors.
Yes.
But regardless of age, nonetheless, it is still a very powerful tool. Then I think that the automatic increase in contributions, even if it's just a percent every year, it's, in a sense, it can kind of save us from ourselves. I think we've talked on a previous episode how as time goes on, we seem to make more and more money. However, we feel like we can't necessarily get ahead.
Yes.
And I think it's just the natural human thing where as we make more money, we let our quality and our standard of living increase at the same rate that our pay increases.
Yep.
And we're not sitting here advocating that you shouldn't enjoy some of the finer things in life, or when you get a big promotion, enjoy some of the money. But it allows you to increase your savings at still a slower rate than you're making more money, but still increase it automatically. It's just a super smart thing to set it and forget it, like you said.
It's the pay yourself first, live on the rest is kind of how that flows in.
I like that. Okay, so number 4, really big one, and we preach this with nearly all of our clients, regardless of age. But number 4 is building non-retirement investment balances.
It is my soapbox.
Get on it and let's hear about it.
So I'll give you an example. Let's just say a client has $1 million, worked their tail off through their years. They put money away because they're always wanting that tax deduction for the retirement account. They have $1 million. They get to retirement and they start pulling money out of the account. It's really not $1 million because every dollar that comes out of that retirement plan is now taxable. So even the best case scenario, they're at a 12% tax bracket. You got 12% of every dollar that comes out of that plan is now going to Uncle Sam. And the bigger account balance, the more money you're taking out, the higher the percentage you're paying in tax. So the ability to fund investment accounts, just like your retirement plans, that are, we call non-qualified or non-retirement funds. It's like a savings account with investments in it. Gives you flexibility in retirement. And for those that want to either retire early or want to be able to do things with their investment dollars prior to retirement.
Flexibility.
That gives you that advantage. And there's also one really big one for our high net worth clients. When we eventually all pass away, we want money to go to our beneficiaries. A pre-tax retirement plan goes to the beneficiaries. They then pay ordinary income tax at their rate. Whereas these non-qualified investments or non-retirement investments get what's called a step up in cost basis, which is like the IRS magic wand that eliminates all gains that you've had in the account, and it goes to the beneficiaries right now 100% income tax free. So it can be a huge benefit.
So if someone bought Apple stock in 1990 and has been holding on to it ever since, and they pass away and they have a gajillion dollars in gains, if they pass away and then after they pass away, gift it to their kids or a family member, they don't pay anything on the gains.
Zero. It's as though the kids or the beneficiary literally bought it on the day you passed away.
That's a huge benefit, and that should be motivation enough to open up a brokerage account. So when you say non-qualified money, that means after tax, similar to a brokerage account, right?
Think of a savings account with investments in it.
Yeah.
And that's, again, shameless plug here. That's really the value that we as advisors bring to the table of working with clients. It's which buckets of money make sense in which scenario, what investments to go into each bucket of money, and what percentage to be saving across the board. We put it together in a nice seamless plan. You don't have to worry about it. We worry about it and get you on the right path.
That was a good soundbite. That's going to be a short for social media.
Go.
That was good. You're spot on, man. I think investment management is it's not all that we do. It's a byproduct of what we do, but there's also the estate planning and tax planning side of things, which is often overlooked. But little tidbits that you just mentioned can save families tens or hundreds of thousands of dollars just by being smart in the buckets that you save in, like you said.
Absolutely.
Okay, cool. That was your soapbox. I'll give that one to you. I have nothing to add. That was a good one.
I'll step off now.
Okay. Maybe I'll get on my soapbox for one of these. Number 5, reviewing charitable goals. It's honestly a good thing too that this episode is going to air before the end of the year. This is a good time to consider these things before the end of the year, but also going into next year too. So what is the conversation you have with more charitably inclined clients?
Yeah. So let's write down, going back to our plan, let's write down what causes we want to support, what dollar amounts we want to give to each cause. Mm-hmm. And then let's take a look at it from what is your tax situation. Don't want to get too boring on tax conversations on this podcast, but with the standard deduction right now, as high as it is, most clients do not what's called itemize. Mm-hmm. So by taking the standard deduction, your money going to charities does not actually benefit you from a tax deduction. Mm-hmm. So there's several strategies we can look at to say, let's group, kind of pull together from future years into a current year. Let's make a charitable donation. And in this case, what we can do is what's called a donor advised fund. They come up with very interesting names for all this stuff, but donor advised fund, where we can actually give a lump sum amount of money. It can be funded with cash, or it can be funded with highly appreciated investments. It counts as a current year charitable donation, mm-hmm. but you don't actually have to give it to the charities in the current year. So it's an investment vehicle, which then allows you in future years, because you were going to give the money anyway, in future years, just go to the donor advised fund and say, hey, send out X amount of dollars from this investment account directly to the charity. The charity gets their money in that year, and you were able to get the deduction in the year of which you made the lump sum gift.
That's and donor advised funds are something that we can also help set up.
Absolutely.
And I'm glad you use the term highly appreciated assets, because that is yet again another tax planning tool where mm-hmm. you can pick and choose what assets you may want to gift just because of the potential tax consequences. Yes. The timing of it's huge as well because of the ability to, like you said, lump together multiple years into a donor advised fund yes. to allow you to get over the threshold of mm-hmm. itemizing. So for anyone out there who maybe uses TurboTax or maybe not be super savvy with deductions and itemizing. Mm-hmm. So in 2025, the standard deduction for married couples who are filing jointly is going to be $30,000. Mm-hmm. So just to kind of clarify what Scott was saying is you will need charitable contributions and other things to get you over $30,000 for those itemizations to count. So things that count, like we said, charitable contributions, yep. interest on your mortgage,
mm-hmm. property taxes,
things like that. So if you have all those things combined and they equal less than $30,000, it's still great that you gave to charity, but it doesn't help you on taxes. So
Right.
lumping them together in one tax year to actually benefit from that, you can get more than the standard deduction, and that's when it would benefit you.
And we're all proponents of paying our fair tax. However, if we don't want to give Uncle Sam more than what Uncle Sam needs, so we like the little magic wand that Uncle Sam is the one that gave us the wand, to be able to kind of get around some of this to minimize taxes for you, ultimately benefit, in this case, the charitable organization that you want to give money to.
I like it. Let's bring this one home here. So our last one, number 6, is reviewing insurance coverage. It's probably about as fun as going through and unsubscribing from emails when you get spam. You'd rather just...
that's a good analogy.
Oh, yeah.
That's a very good analogy.
But it's to me, it's almost irresponsible to continue paying a bill or having a policy or coverage, or I'll unsubscribe from Netflix next month, whatever it is. If you don't know what you have,
Right.
why keep paying for it? So it's a great time just to review it, right?
It is, absolutely. Why don't you talk about some of the different types of insurances, what we're referring to? What are they actually reviewing?
So health insurance is one, and this can be through work or for COBRA or whatever you have. If you're soon going to be empty nesters, for example, or if you are having a certain kind of health plan where you got on it because your kids get sick very often, or they're getting to an age where they're not in daycare anymore, or they're getting sick less often, or they're moving out soon, or you no longer have kids in braces. These are chances to reevaluate the kind of dental plan you're on, the type of health plan you're on. Right. You don't need to continue paying a high premium, or if you think you need more coverage, you can pay a different kind of premium. So just evaluating that based on where your family is important. We can talk home and auto too, but feel free to add on to that.
Yeah. So one of the big ones, again, I'm gonna get on another soapbox, is that it's overlooked for high net worth individuals, is an umbrella liability policy. Again, how they come up with these terminologies is funny to me. Literally, just like an umbrella does, as we're walking outside and it's raining, it kind of protects us, right? It's a bigger section that is no longer getting soaked by rain. The umbrella liability policy also comes underneath, like the umbrella of your homeowner's insurance, your auto insurance, and provides you additional liability coverage. So, worst case scenario, right? You get in a car accident and it's a bad accident. Your auto insurance policy will only cover X amount of liability. So, in these, you see the billboards all the time as we're going down, the road. We won, $3 million for our client. The umbrella policy will give you that additional coverage, so you're not getting personally sued. So that's a big one and oftentimes overlooked.
Great point. I think it is often overlooked. I think the last one we should probably talk about is life insurance. Pretty self-explanatory. I think the majority of our clients either have a policy that we help them get through a third party or through work, which is great. But long-term care, especially for those who are probably getting into their 50s and maybe have seen their parents have to deteriorate mentally and physically and don't want to be a burden to other people when they age too. Long-term care policies are definitely something to consider.
Yeah, and why don't you just briefly kind of go over what a long-term care policy roughly covers? Yeah,
you're essentially semi-locking in your rates now for long-term care, and you're prepaying for it now. Very rarely will you prepay for to cover 100% of it, but it's a chance for you as you get older, if you need to go to an assisted living facility or nursing home or get some type of care, that you can start paying towards that now, so you're not a financial burden to your kids or your family as you age.
Right. And it protects those assets that you can either protect the spouse that is not in the facility or needing care, or has, like you said, money left over, so it ultimately goes to the kids. I do want to go back real quick to the health insurance.
Okay.
The one of the things, clients 65 years of age and older are on Medicare. One of the things that we can very much bring to the table that we hear about quite often is the income thresholds for your Medicare premium Part B. It's tiered based on income. There's a lot of strategies that can be put in place to either minimize income or plan for the income to try to make sure that your Medicare Part B premiums are not taxed at the higher rate. So if you find that you're continually falling in that and getting the notices, my Medicare premium's going up by X amount because of the income, by all means, reach out to us. Let us kind of help you walk through that and maybe put some planning pieces in place.
Smart. Good point. I have nothing else to add there, and I think that does it for this one. Any closing comments?
No, I think on behalf of all of us, wishing you a very happy year end, a Merry Christmas, happy holidays, and looking forward to seeing you all in 2025.
Yeah, agreed. Thanks for joining. And if you're interested in more educational content, stay tuned for part 2. And as always, you can find us. We're at Definition Wealth on Facebook, Instagram, LinkedIn, Spotify, and YouTube. Thanks for listening, and we'll see you next time.
See you soon.
Thanks for listening to today's episode. We hope you got some major value from our conversation. If you have a question for the Definition Wealth team, please reach out either through the show, on our website at definitionwealth.com, or on our social media platforms. We are at Definition Wealth on Facebook, Instagram, LinkedIn, YouTube, and Spotify. See you next time.